In this video, trader is going to answer the question: I got screwed on an order I put through with the broker. Is it illegal? And what can I do? If you're in this position, stay tuned. Hey guys, warm welcome to you. Alright, so this came in and it said, hey, I've been absolutely screwed on an order I put through with my broker. Is it legal? What can I do? And the order was a market order. So a market order, MKT generally on your ticket, or whatever broker you're using, however they phrase it. And immediately, if you know your order types, you know that actually the market order is opening you up to be screwed, as this guy says. So how a market order works, guys, and why you got to be careful of it is this, especially if you're on a thinner instrument. So you've got your order book here, if you like, and there is your bid, and there is your ask size. And I'm going to touch on this very briefly. I've done kind of deeper videos into level 2. If that sort of stuff interests you, go and check it out on the channel. You've got your spread. Let's say we've got 55 to 56 here, whatever that number may be. You've got your buy orders stacked here, your sell orders stacked here, and when a trade is done, then that's when the price is transacted. So let's say trade's done at 56, 56 prints, 56 again, 56, etc. Now, if you're using a limit order and you're coming in and you're buying at 56, if you're buying, let's say you're doing 1,000, okay, at 56, if there's 1,000 there, you get filled. If there's 500 there, you take the 500 and you would then become the best bid with your other 500. So you're never going to get a worse price than 56. Basically, a limit order says do not pay, if I'm buying, do not pay more than 56. So in other words, sacrifice filling the order, but I do not want to pay more than 56. If I only get 1 share, I get 1 share. If I get no shares, I get no shares. I'm prepared to buy up to 1,000 shares at 56 is pretty much how it is explained in words. Now, if you were to do a market order, and okay, maybe you clicked it when it was 56, but the fact is there's no price attached to a market order. You might think it's a market order 1,000 at 56. It's not. That's just the time that you press the market order button. A market order says buy me 1,000 and I don't care what price. That's what a market order is. It's giving the broker, not really the broker, but it's reducing or removing, should I say, any control over the price you are filled at. Now, if you are a small fish in a big pond, you can use a market order all day long, and you will never ever see any problems with it for as long as you're trading. So, for example, if you're trading euro US dollar, and you're trading a relatively small amount retail account, never in a million years are you going to have any problems with the market order. The only problems you may get are if, let's say, you get slipped because there's some sort of lag between you pressing the ticket and it hitting your broker. Now that could happen, but if we assume that everything's hitting the order book or whatever it is at exactly the same time, or exactly the correct time, you're not going to have any problems because there's going to be so much volume there to kind of soak it up. Now, this guy had been filled something like, he put in 1,000 at 56, and he'd been filled something like 800 at 56, and then a 200 more at something like 89, something ridiculous like this. I'm not sure if it was a stock or whatever it was, but the point is it was a lot of difference between kind of the first fill and the second fill. It's like, well, I've been screwed on this. My average price is horrible. It's way above, where it should be. What's happened? So this is exactly what's happened to this guy, is that you've got the order book here, and like I say, I don't know what it is. It could be a stock that was thin in the mornings. Sometimes you get that, especially in the London Stock Exchange. It could be a futures contract with a FAR month, so it could be something that's very, very thin. And I've been caught out by this before and making the mistake trading a FAR month contract and getting stuck in it because there's no liquidity there. It could be something like that. And so if you can imagine the order book was kind of looking like this. Let's imagine it was 55 to 56, and he's got his order. In fact, let's use this order book here so we're not cramped up. So let's use this order book here, 56. So then the next, so there's his 56 there, and he's got, there's 800 sitting on the order book. But the next print, for whatever reason, is at 89. There's just a massive gap because there's no liquidity there. Liquidity's dried up, so it's gone from 800 at 56. So it's gone for 200 at 89. And then he's got 800 at 56. and that's it. There's massive gaps. In normal market conditions, you probably find that these gaps were filled. Some were going at 57, 58, 59, and that 89 would be nowhere to be seen. It'll be well up out of the view. But for whatever reason, there's no liquidity there, and that's just people putting orders in. Maybe it was after data, before data, all sorts of times when it could be. And what's happened is he's gone right 1,000. He's thought he's clicked it at 56 and he's filled him 856 and 289. He's got his fill back, his average fill back, and gone, ouch, that's horrendous. And that's what happens, guys. That's the problem you have got with market orders. You know, most of the time they're fine, but be careful. If you're trading smaller stocks like, you know, that are less liquid, then don't use a market order. If you're trading futures contracts that are, again, less liquid, don't use a market order. If you're trading futures contracts far month, then don't use a market order. If you're trading anything where liquidity is in doubt, then don't use a market order. If you really must, the way to combat this is to always use a limit, but use a limit a couple of ticks above so you make sure you're filled. So of course, if you've got to put a market order in at a market order at 56 and the price was 57, you wouldn't be filled. Sorry, if you put a limit order in at 56 and the price was 57, you wouldn't be filled. And that might not be in your best interest. You might be like, hey, I want to buy this. I don't mind paying up to 58 for it. If that's the case, and you're kind of one of those people who tries to catch those turns and needs that little bit of aggressive order entry, then use a limit, but use it a few ticks above the market. So use, you know, a limit at 58, a limit at 60, whatever, so that you're still getting filled whatever time the order flow hits, even if the market's moved by the time your order hits there, etc. But you're not getting screwed on something like this, because if that was the case and you put a 60 limit in, 1,000 at 60, you get your 800 at 56, and 200 would just sit there at 60 then, and you'd be the best bid at 60 with 200, because that would be the best bid and that's the best possible price you'd pay. And you might get filled on that, you might not, but at least you're not going to get the slippage up to 89. So, moral of the story, guys, be careful with market orders, specifically in those circumstances I talked about. If you're trading big, thick stuff like Forex, like the big pairs, that is, be careful of some of the exotics, like the big pairs during regular trading hours with a reasonable size, then you're going to be fine. But as a precaution, you could always just say, okay, well, I'm going to use limits, but I'm going to use limits a little bit higher to make sure I don't get this kind of massive slippage. And by the way, one final thing is, that's in the kind of, in the exchange, a lot of spread betting CFD brokers will allow you to put some kind of slippage factor in, or boundary factor in, or whatever it may be. They all call it different, which means that when your ticket goes through, you don't get that amount of slippage. And that means, generally speaking, the way they do that is it just won't fill you. It just won't fill your order at all. It'll say, well, you know, the market's moved too much, you need to replace the order. So it kind of, they're adjusting the way their order flow, their order styles are done just before the retail crowd. But if you go into the market and the actual exchange, then that market order will just get fired out and you'll get filled at whatever. And actually, the final thing, guys, before we wrap this up, that's how circuit breakers often get kicked into stocks. I've seen stocks that are traded and they've been very, very thin on the bid. Someone comes in, hits it with a market order, it sweeps the level, and there's no more levels to soak it. When it hits and prints the next level, that hits the circuit breaker and freezes the stock. So often that sometimes can cause circuit breakers to trigger. That's by the by. Anyway, guys, I got screwed on an order. What should I do? Think about that one. Take care. Bye-bye.